Good afternoon, everybody.
Hello.
Thank you for joining us today. I know it's 9th of July. We'll be talking about the independent operator today, as you know. The next webinar is already settled, and we'll be talking about alternative fuels. It will be after the summer, early September, the 5th of September, same time. You will receive the invitation, and you will also receive the slides of today's presentation. So don't bother taking any screenshots. All the materials will be handled to you. Today's agenda, so it will be as following. So we will go quickly on the information of Project Smart Explorer. I believe now you all know the tool. And then we will have a funnel approach as usual, starting with a bit of definition of what we mean by independent operator, their history, where they come from, and moving to how they work, how they operate, and down to the list of the key operators per application and per country. If you have any question, don't hesitate to ask them. Just ask them in the chat, and we will address all your question at the end of your presentation. And moving to the next slide, I think we can skip. That's the both of us. I think now you're used to ourselves. The same for our customers. Just a quick information for this slide. This summer, sorry, we will include mining as we already communicated. So during the summer, you will start to see some new application concerning mining popping in a Project Smart Explorer, and we will start to include some new projects in mining this summer. Let's say the objective is to gain traction over the months to be full speed by the end of the year on that subject.
Going to the definition now. Thank you, Jack, for this introduction. The idea, because when we talk about independent operators, is to try to, let's say, go a little bit more in the details and be a little bit more also explicit about what we are talking about. So all the figures that we are going to cover today and we are going to discuss and present at the end, especially the project outlook by Jack, are about independent operators. So why do we call independent operator? I would say one of the definition is an exclusion. It's when we mention the operators which are not, if you know Project Smart Explorer, IOCs or NOCs, meaning it's the companies which are not IOCs, international oil companies, meaning the majors, Total, Chevron, Exxon, BP, Shell, the big boys. So not this category. And which are not NOCs, NOCs standing for nationally owned companies. That's where you find companies like Equinor, Saudi Aramco, ADNOC, Petrobras, Petronas, companies which are driven either directly or indirectly by their government. So independent is a little bit, I would say, all the other category that you can find, and which are either not majors or not nationally owned companies. So that's, I would say, the first definition. In terms of scope, here on the left on this graph, you see that the IOCs major represent around 20% of the market, 45% of the market is represented by the NOCs, and the independent that we are going to talk about today represent about 36% of the market. And it's quite interesting because you will see it's a growing market share, and it's a category where you have the biggest number of companies. And we put you here on the left the number of companies for each category. So 13 IOCs, 200 NOC company, and around 400 companies are generating into those independent. So independence, I would say, at the origin, were really US and UK company, and also it has started to grow in China. But I'm sure you know a lot of names into this category: Apache, Sapura, DNO, Kiswana, Darko. Many companies like this. And what is quite interesting to know is that those companies are usually highly specific on, I would say, one type of application. And when I say that, there is a kind of a verticality, not to call a niche, to define this independence. That's, I would say, the biggest difference with IOCs or NOCs. If we try to make a spectrum out of the energy market, I would say IOCs, if you take ExxonMobil or if you take Total Energies, those companies, they can operate projects of FPSO, deep offshore in oil and gas. They can make LNG projects. They have refineries that they operate, and they are also stepping into energy transition with solar, with carbon capture, with everything. So their scope of expertise in terms of project in energy is rather broad, and they're also quite global. If we turn to NOCs, if you take Aramco or if you take ADNOC, they were really upstream for quite a long time, deeply into oil and gas, but they are also starting more and more to go into petrochem with a lot of refineries capacities and also stepping into energy transition for their own, I would say, need of energy. And that's really one of the key difference with independence, because there is many companies where we'll see in a moment some example. Some are really dedicated, for example, to shale oil or shale gas, or to the transport of this oil and gas. Some of them are really focused on, I don't know, ethylene cracker, on aromatics or fertilizer. And you have some companies, especially in the scope of energy transition, which are highly focusing on one key application, carbon capture, e-fuel, blah, blah, blah. So it's really one of the key difference between those companies. Even if independents can be really large companies, they are really still focusing on one or two type of application, and that's really the difference with IOCs or NOCs, which have a scope of expertise or in terms of project panorama, which is way bigger. So just to give you example of companies and a segmentation of this broad category, because you can see independent is quite, I would say, a broad name. There is three parts in this independent category that we identify and behave a little bit differently. The first one are, of course, the historical companies, which have been, for example, Ineos, Air Liquide, Linde, Air Products, but also the chemical company like BASF, Bayer, or yeah, the fertilizer company. Those companies have been out, I would say, for quite a long time. Some of them 20, 25 years, some of them 100 years, for example. And here, those companies are quite well established, really focusing on few aspects of the market, but with a long backlog, with a long history of in the supply chain, etc. But they do not respond to, I would say, fully to the market. Sometimes they are also privately owned, or not fully owned, but massively owned by private investors. And they do not, I would say, answer to their government in terms of decision taking for a project. The second category, and it has been recreated with the shale oil revolution in 2014 in US. It's a lot of players which are especially, I would say, working on LNG, either shale gas to produce LNG or LNG transportation. And here you find four names: Tellurian, Sempra, Cameron, Glenfarne, many names that you can find mostly in US, some of them also in Australia or in UK. Which are not fully shale, but still really oil and gas upstream. You can find also other examples like Perenco, etc., which are really a generation of companies which have appeared, I would say, to 2014, so being, I would say, 10, 15 years ago. And then you have the last segment of this category, which are really taken off, I would say, in 2020 during COVID, which is all the startup, and not startup meaning small companies, but I would say new companies, which are starting to exist after we start to look into energy transition, and that's why 2020 was quite a big year. And here we try to mention four names of different profile company, QR, depending where you sit on the planet. It has a different name, but which is a French player in energy transition. Semi-Carbon Solution, which is a US company coming from the farming, I would say, industry, coming to decarbonation. Copenhagen Infrastructure Partners, which is a huge investor in energy transition, and Neom, that I'm sure you know, this giant company for even giant project in Saudi Arabia, which is also making this kind of I would say, big part in this category. So that's how we split it, I would say, the segmentation. It's one of the more natural, depending, I would say, mostly of a timeline to know, but also you see it's quite specific in terms of markets, because historical companies are really, I would say, mostly on the petrochem aspect and chemical even. Then you have a big part which is more on oil and gas, and the last brick on the right is mostly focusing on energy transition. So a little bit about the history, because as you see, we were talking about generation of companies, and here we try to dig into our data of Project Smart Explorer to check on the last 10 years what has been the development of those companies. And what is quite clear is to see that they are really doing a big part of the market, because before they were doing more or less one quarter in 2014 with 40 companies, which was quite a rather small category, to be honest. And then you arrive to the category in 2017, whereas market share is more or less the same, but the number of companies is growing, especially in US. And then in 2020, before I would say the energy transition shock, you see that the market share is growing, starting to grow quite massively. But the number of companies is more or less the same. And here the growth has been made by all the shale oil and gas companies, which are starting to take a huge momentum of the market. And of course, here in 2023, you see that the panorama has changed quite a lot with a high number of companies, and which are really driven by this energy transition effect. So you see four timeline, which are showing those wave of independent company taking momentum on the market to the point of today where those independent companies represent between 35 to 40% of the market, which is quite massive, to be honest, and sometimes a little bit underestimated by many players of the market. We want to focus on IOCs, want to focus on NOCs. But at the end, if you compare the big boys and the majors, I mean, they represent half of the market. That's those independent companies. So I think it's quite important to have in mind, and that's why we're having this session today to talk and focus only on independent companies. Up, yes, perfect. Show you the same, I would say, evolution, but in terms of capex and number of companies, you see this evolution of capex being awarded in billions, where in 2014 it was roughly 80 billions, more or less, where it started to grow thanks to LNG to 120. That was more or less the benchmark for independent operators of award per year, so it's quite massive. Because we are talking about billions of US dollar. And you see here the big jump it has been made thanks mostly of energy transition, where we are arriving to 200 more or less billion being awarded every year by independent operators. And of course, you see the jump in number of companies is quite massive because of this new market opening. So the dynamic is going up, clearly independent. If you are following our previous webinars, you know that the market is going up, and this going up is mostly pushed by NOCs and by independents. So of course, it's quite important to place yourself on those independents because they are the ones doing this market, especially in energy transition. You will see in a minute. So we wanted to focus on one crunching year because you see there is quite a jump in 2020, and you might wonder, okay, why there such a break? And it has been quite a tough year for everybody. I mean, obviously because of COVID. But if we put ourselves in the shoes of, on one case, oil and gas producer, independent oil and gas producer, especially if we look in US, it has been a tough year. Because at the beginning of the year 2020, around March, April 2020, you may remember that it was quite historic because the price of oil went negative. It didn't stay for long, but for quite a time, you could be paid, I would say, to store oil. So if you had a spare tanker on your garden, you could have made a lot of million in profit because of this situation. And a lot of companies, independent oil and gas producer, suffer from this situation because it was quite a war price organized between Saudis and Russians to target those US producers. And it worked very well till the summer, where the demand for oil came back quite quickly, to be honest. And then the company that didn't go bankrupt on those 6 first months of the year 2020 started to receive ton of money from the bank because at the time you might remember that the interest rate were negative. So banks were really happy to push billions into those independent companies to produce as much oil and gas as possible and to make sure that the US could become independent on their own supply of oil and gas, but also become a net exporter. So the US companies, especially in shale gas, were started the year taking a lot of losses in 2020 and end up the year receiving a lot of money to invest in new projects. So that was quite a roller coaster for them on this year. And that's why, of course, it has long-term impact, because when they start to make a lot of investment in 2020, you start to get the orders in 2022, 2023, 2024. So it's quite interesting. So if we put ourselves in the shoes of energy transition company, I'm sure you have witnessed and you are mostly working on it that since 2020, a lot of government have injected hundreds of billions in energy transition, a lot of public money, but also it's a common interest, I would say, to go into energy transition, can be renewable, decarbonation, etc. And a lot of new players, new companies have been created. They were either, created from the roots, like startups, or they were spin-off of existing companies. Utilities start to go also into energy transition, not only to distribute gas or distribute electricity, but also to produce clean or sustainable energy. And we also see arrive a lot of I would say heavy consumer of energy, mostly industry, which starting to put a foot into this energy transition for their own, I would say, decarbonation. We could see that into the steel business, in the fertilizer, etc. So a lot of companies enter energy transition also in 2020, and that's why you see such a jump into 2023, is because all those aspects which have happened in 2020 have of course going into execution in 2023, and that's why you see such a jump. Now, if we look 2023 to 2024, I would say we are at the end of those both effects, I would say short-term impact, and now the market is going more for a consolidation and a cleaning effect. I'm sure you have witnessed, and here we try to take some, I would say, headline from a newspaper that we see around, where, of course, I'm sure you've seen into the oil and gas world that there were a lot of acquisition, mostly made by majors, to acquire small independent companies. Conoco acquired Marathon Oil, I think 2-3 months ago. Chevron is still trying to acquire S Corporation for 50 billion, so quite a big deal, but it's blocked by Exxon, which on its side, Exxon has acquired Pioneer Natural, which was also a big acquisition also of independent companies to position themselves back into the Permian Basin. And Total and Shell and BP are also acquiring a lot of companies, of independent companies. So 2023, we see a lot of development, of course, of independent, but into the oil and gas, we see also a lot of consolidation of those companies into majors, because, I mean, when you see the size of those acquisition, 50 billion, 60 billion, we are not talking about small companies anymore. Those are massive companies. And of course, it's not the same, I would say, instrument and vehicle of production when an operator start and they are, I would say, 500 million size, and when they become 60 billion size. So sometimes they just get integrated in those big groups because it feels just more natural. As the opposite, if we look, I would say, on not the consolidation, but maybe the cleaning. As I said at the beginning, you see there is 400 companies in this category. It's quite a lot, and I'm not sure all of them will still exist in a few years. And we start to see some, not consolidation, but some companies disappearing. That's the case, for example, I'm sure you've seen the line of Zachary LNG, which is a contractor which was driving the construction of a project of LNG export in Golden Pass, and had filed for Chapter 11 because, okay, they were not able to be productive and to be competitive in this market, so they are disappearing. Of course, you have other contractors which are going to take over this project, and the project will happen anyway, but it gives you a little bit the consolidation it can go. Now, if you look at other markets, not only oil and gas, but also hydrogen, Universal Hydrogen, which was one of the leader about the hydrogen plane, has went bankrupt because this company was created in 2020 with a target to produce and to develop this hydrogen aviation, I would say, market. And okay, there is just no market, so nobody is able to invest a bit more in this company, I would say, to industrialize the concept. And Plug Power, which is really a known game in the market, we start to see some headlines saying, okay, will Plug Power survive 2024? Because they're starting to run out of cash, and they are it seems quite hard to find new investors today. To give you an idea, I would say at the peak of Plug Power, the share were trade around $70, if I remember correctly, while today it's more around $4. So it gives you the latitude of the company. But for energy transition and independent companies inside energy transition, we are a little bit at the end of the, I would say, trend and hype around the market. And in 2024, we start to see as a request of those companies to create value, to create money. And for sure, a lot of companies will be able to do it and they will turn to the industrialization that will still exist, but many companies will also disappear in the meantime because they were not competitive enough to go in that market. So that's why we're at the end, I would say, of the bubble and starting a period of maturity around this market. And independents are part of this market. So, of course, they will go through the same pipeline, which means that we'll see a lot of also champion appear from this category. And with Jack at the end, we'll try to show you and point you some names that might become a champion in the future. Talking about those companies, I think it's quite important to realize how they work and how you can, of course, help them to do the job, because their operational model is a little bit different. And one of the key difference might be the EPC contract they are using and their mentality. A big portion of those companies, way more if you compare it to IOCs and independent, are using reimbursable contract. You might know that this EPC contract is quite important because it drives, I would say, the relationship between the operator and the engineering company. And independent operators are quite keen, or at least keener to use reimbursable contract. And those reimbursable contracts are, you can find them either under cost plus fee or open book contract. Are contracts which are not, I would say, a fixed price for the execution of the EPC contract. It's a contract where they are going to be awarded the EPC contract, and they are going more or less to invoice the man hours that they are going to spend on this project, plus the price of all the equipment and services they are going to acquire from it, and usually a small, I would say, plus fee of 3-5% to make the value. Originally, this contract was mostly used in North America, India, and China, but now we can see it used being, almost everywhere, sorry. And what is quite interesting, especially as vendors of equipment and services for this project, is that the execution of the project is into the end of the engineering companies, but the last call decision for equipment and for, I would say, the selection of vendors is into the end of the end user. Not the same way as lump sum turnkey as you might be used to. And it's quite important because it means that in this kind of project, you need to talk to the end user to make sure that the last call is to you because they have identified you, they're happy with your product, and you can make the difference with them. So it's quite important to have in mind that in this kind of companies, you still need to address the operator because they'll be the last one to take the decision. And why do they do so? Why do they use this reimbursable contract? Is because those projects, and it can be a little bit counterintuitive, have proven to be less expensive. Why so? It's because when you're an engineering company and you take an EPC job, it can be a high risk. If we look at even big engineering companies, their market capitalization is around 35 billion US dollar. So when they take a project of 5 billion, for example, for a big project, their, I would say, exposure to risk is around sometimes 20% of their market share or market size. So it's a big risk to execute the project. So they increase the price of the EPC work by 20, 40, sometimes 50% just to cover the risk of this project. When you use a reimbursable contract, as you just invoice the number of hours you are going to work on the project, of course, you don't have the risk. The risk is covered by the operating company. And if you take some of the companies of independence, where they weight 60 billions, 70, sometimes 100 or 200 billions, of course, the value of the risk when you sit on 200 billions and the project is 5 billion is way lower. So it's really easier to absorb this kind of risk. So that's why the project is less expensive, because you really cut down this cost of risk. Then the project is less expensive because it's quicker to execute. As you invoice as an engineering company the man hours, I would say it's operator deal is to make the project go as smooth as possible and spend less amount of time to execute the project. So they're really happy to execute and support in decision process the engineering company to go fast. Where when you have in lump sum turnkey, usually you have a fight between the engineering company, which has its own budget to push for decision of process that the operator might not be interested in, and then you go on and on for weeks to discuss a problem of design. I'm sure you know the situation and you have been in this kind of situation. So of course it takes more time to execute the project, and at the end it costs more. And then the last part, which is quite important in this kind of project, is because when you receive an EPC bid for an lump sum turnkey, you need to have the skills to evaluate those EPC bid. And sometimes those independent companies don't have the engineering resources to make the evaluation of the EPC bid. So they're not interested by a lump sum turnkey project. They're interested by reimbursable because they know that they have no capacity to make those evaluations. So they just trust the contractor to do the work. So again, that move them to reimbursable. It means that you need to be really upfront because most likely it will be a conversion from one contract to another. You are familiar with this slide of traditional business model and new business model. The difference being new business model, you take the contract of feed and you convert the feed contract to EPC contract to the same company, while on the traditional business model on the top, so one company is doing the feed and you organize an EPC bid and someone else is doing the EPC. The market is more or less 55, I mean, the global market is more or less 55% today for this new business model. If we look into independent companies, they are high user of this new business model. In fact, they are the one who created more or less this business model, and they are using, I mean, for more than 2/3, by 70%, this business model to accelerate project, for project to cost less, to be done, I would say, quicker, but also because they don't have the capacity to organize, for many of them, this EPC bid, so they are not interested into the traditional business model, which means that for you, you need to adapt to this model for this majority of the market, which means that you need to be at the field, because if you are not at the field, you will never be at the EPC. I mean, they are chasing to make sure that they go as fast as possible, which means that all the decisions which have been made at the field will be executed at the EPC. So again, if you are familiar with this new business model, go for the independent, because that's where the majority of the business can be done using this model. Now, what's your strategy around those independents? Because I mean, from what I said earlier, it might not be super sexy, to be honest. But you have to understand why this market is interesting. First, because it's no more marginal. I mean, we're talking about a market which is 40% of the total market. Which is representing a big part of the market, and it's a must-have. It's a must-have simply because that start to, I mean, that's the market where we start to have the future of energy champions. Of course, energy companies which are quite big today will remain in the future, but there will be new players as well to this market, and that's where, in this category, independents, where they are going to grow, and that's really where you need to go if you want to have, I would say, to benefit from this dynamic that we have as of today, because that's the segment of the market where we have the best growth. So in a market which is growing, of course, you want to go for the players which are driving this growth, and this growth is mostly driven by independent company today. So that's why you should go. Now, why you should not? Of course, it's a massive number of players which have sometimes low visibility to almost no visibility. So it's quite tough. But in the meantime, you can go in this market without targeting everybody. And in terms of visibility, thanks to Project Smart Explorer, normally you are aware of those projects. So what you should do, I mean, to drive yourself to those companies, that for some of those companies, have you understood, they have not been around for a long time. So, I mean, they were not existing before COVID, so they don't have vendor list. That's not how I would say they are used to work. Sometimes we see companies where there is no supplier competition. They have one valve manufacturer to provide everything, and they use it not only for their product, but also for their technical know-how, because some of those companies, they don't have, I would say, floors and floors of engineers, so they request the supply chain to support the technical design of the project, and of course, to fast-track those projects as much as they can, because they make more money by going faster than just discussing about project and your prices. So now the idea is how to do it, and that's where we can help, because it's clearly too large to address as a bulk. The idea is to focus. focus on first the countries, because you will see that they are not everywhere and neither are you. So it means that you need to focus on the country where you have a lot of those companies and you are really present with a good footprint, but you need also to focus in terms of application. Application is making quite a good argument for you to know if you have a competitive advantage or not. So you need to be sure to focus on the application where you have the best chance, not to cover everything, but just to go where you have the best competitive advantage. And the last point is, of course, use Project Smart Explorer to make a top 10 of the company which are interesting for you. Use, I would say, the Excel report you can export, and then playing with different filters. I'm sure you can build up quite quickly in a few minutes the top 10 of companies. Some of them you might know, but you didn't expect them to be so high. And some of companies you will discover because they can represent a high volume of opportunities for you. If you really need some support there, we can also help you. In a slide Jack would presented, we have started to make a little bit the work for you. Project outlook.
Yeah, thanks, Jean. Moving to the project outlook, and the first information that we can provide is the concentration in terms of country. The first information that you can see on the left table, it's an investment being done in US, and so by far US is leading the game from independent point of view. To equalize this, to equal this number of investment, you need to add the following 6 countries. So they are doing a third of the market. Another way also of looking at this information is looking at their market share in descending order. And here, of course, US is still on the list and Canada too, but you have other countries, European countries like Portugal or Sweden, where 80, 90, sometimes 100% of actually the projects are being done by these independent operators. And the reason is also when you look at the application. If you look again at the application here on the left, you have the capex in descending order. As Jean explained before, the push initially came also from LNG, so that's why LNG is the first application. And then on the list, you have a lot of energy transition application, which is even more self-explanatory when you look on the right, which is again their market share in descending order. And here you have basically all these new applications from green hydrogen, green ammonia, green methanol, where they have almost 90% of their market share. You also have in the list all the carbon capture application. All these new applications and synthetic fuels are also in that list, are being led by independent operators. You have here a list of around 20-25 applications, and in this list, they are doing more than half of the business. If we look at the evolution of the capex, you recognize here what you see also in your product lines, because that's also how it's happening currently. There is a huge demand for business. Of course, this cannot happen. There is no way the engineering capacity can absorb a multiplication by 2 of investment. That can't happen. So part will be postponed. But if you look at the actual, and that's also very interesting, we see that growth again, and we are, give or take, few days at the middle of the year today, and we already achieved the same level of investment than last year full year. So the push is there. It's already trying to fill 2025 because of this engineering capacity. So there will be growing. And if we look into the details of the application of each energy family, here we have 3 graphs and basically 3 different stories. The first one that we can see on the top left is the oil and gas. So basically, as we said, LNG application. And we can see the different phases of each project. So here we have the first phase. We are currently being awarding the second phase of the LNG projects, and this standalone bar on 2027 is phase 3 that will come in the later years. If we look at petrochem, the business is a bit more complex for petrochem. The achievement of 2023 was low. Very low, like COVID low. And the reason is mainly due first for the carbon footprint of this project. That's not specific of course, to independent operators that hit all the market, but these are a long-term investment, and they will be on the portfolio for years. So the carbon footprint is the problem, and also the barrel price that is quite high currently. So that impacted also quite severely the petrochem application. Just to give a concrete example, I think that is quite self-explanatory, is the case of Ineos. 21, 22, they were used to make around 2 billion of euros of profit per year. And in 23, they divided by 7 to 300 million. And the first quarter of 24, they actually lost 200 million. So for petrochem, it's a bit more difficult times, but these projects will come later on once the design will be redone. And the last story is energy transition. Here it's more a ladder than actually a bar graph, right? Really going up, and the investments are doubling almost every year. This is where the independents are pushing also very, very hard, and it was a market that basically before COVID was not existing for these companies. Moving to the key players. Here again are following some slides that are a bit hard to digest, or will not read them in the full details. Again, you will have the detail, you will receive the slide. I invite you to actually read them quietly and peacefully, and you can also do it on yourself with the Excel extract. But I think it's also quite interesting to have first the look at the names of the operators, independent operators per family. On the oil and gas, without a surprise, on the top list, it's mainly LNG application from US that are leading the game. In terms of petrochem, here we have more Asiatic company, from Asia Pacific, let's say companies like 3 major names in India, simply because they answer a need that they have locally. They have a local demand for petrochem product, so they created that business for their own demand. For energy transition, we start to have a broader list and start to have European companies. And moving to the next slide. Yeah, okay. And if we look then now at the geography of the projects per family, of course, US is taking the first place. Again, they are doing a third of the investment, so they are on the first spot on all a bit everywhere. But we have a bit again a different story with more European companies moving to energy transition. What is really interesting also is to look at the engineering companies doing the job for these operators. And here the story is a bit different, where we see new names of countries popping on the radar. Of course, here again, the US is trusting the first place. Projects in US are basically designed in US. But we have then European countries like France, Germany, Denmark, Italy popping in the radar. And if we look at the final slide before ending to the conclusion, that could be very interesting to have a look actually at the companies, the engineering companies doing the job. And here there are several names that we already know. So they use names that we all know, like Bechtel, Technip, KBR, McDermott. There are some new names also popping on the radar, especially in energy transition, like STS, Semi-Carbon Solutions. And there are other names that are starting to climb their way up to the ladders. I'm thinking about Black & Veatch, that is growing also thanks to energy transition, that is really dominant also in the US and start to grow also in Europe. So you have a look at this list. That can be very interesting for you. You will recognize most of the names, but some are quite interesting to look more in details. Jean, if I let you do the conclusion.
No, that's fine.
Before ending to the Q&A session.
Thank you very much, Jack. As I said, we'll send you the slides so you can look at those, I would say, tables in more details. If you really want the raw tables, we can still provide, that's fine, but you can do it by your own, normally with your own product line, so it would be more interesting. But as you ever understood, to go to the conclusion, independence, I would say this category of independent operator is no more marginal. Clearly, they are representing a big part of the market, and they are growing. So it really means two things that mostly would drive your decision to go there. And also because they're really driving today's energy transition. When Jack show you the market share, you could see that all the project of, I would say, decarbonation, green hydrogen, carbon capture, all the alternative fuel are really into the end and dominated by those independent companies. So clearly, if you want to go on those market, those are the companies you need to address, and we start to identify a few champions in those markets. If we were discussing with Jack earlier of LanzaJet or LanzaTech, depending on which office you are talking to, but these Spanish companies becoming a champion of sustainable aviation fuel. So clearly, if you want to address the SAF market, you need to talk with those people. And energy transition is really led by those companies, but they are also quite active. If you look at the market of LNG, which is a really large market, they are representing 1/3 of the market. And if you take the chemical industry, between BASF, Bayer, and all the compounds, you might cover maybe sometimes 60 to 70% of this market. So it's quite interesting to see that in this independent category, you can really drive big part and big bulk of the energy market. Now, of course, those companies are focused on verticals, and that's what we explained at the beginning. They are dedicated to certain type of application, sometimes niche application. But if those markets are adding at least interesting term of value for you, of course, those companies are the one you need to address. Know how to address them. The idea is, of course, to play their game and have in mind that they are a huge user of the new business model. So converting the field contract to EPC contract, and into this EPC contract, have a format of reimbursable open book pricing. And of course, for you, it can be quite touchy to play with, but if you have it in mind, normally it should be fine. While those new, I would say, while those independent operators might be new, for many of them, they are quite new. They are still using, I would say, the old supply chain, if I may say so. And is the first layers is engineering companies. In the list that Jack presented, I mean, you knew maybe 80% of those names, meaning that behind those engineering companies, the suppliers are more or less the same. So it's something that you are already doing for most of you. Some companies, engineering companies that you are already covering, it just need you to make the extra push to get qualified on the vendor list of those operators to be able, of course, to address those markets. So it's not something completely outside of the blue. It's something that you can cover. You are organized to cover already. Now the challenge is to say, okay, we need to find the few champions of tomorrow, because in the list that we are providing, some companies will disappear, unfortunately, for us and for them. But clearly, on the list, if you start to target 10 companies, maybe 5 of them will become the champion of tomorrow. And we start to see it appearing a little bit like we see in the chemical business, for example, where you have between 1 and 3 licenses for every vertical, for ethylene cracker, for LNG liquefaction, etc., for gas liquefaction, sorry. Okay, where you have, I don't know, 3 licensing doing everything. And for carbon capture, for green hydrogen, for e-fuel, we see it going in the exact same direction, where you will have 3 licensing doing everything. So now the challenge is, okay, which one is doing what? And of course, by playing the odds, normally you should be able to target those champions and to place yourself on those markets. So what we really advise, and we can help you during this workshop or as soon as we visit you, the idea is to target, really filter down this number of projects and adapt your approach to those segmentation, to those verticals, to those niche, to have the right argumentation, the right, I would say, words to push your offer. For quality, for sure, but also for support, technical support, I would say project support, to make sure that those projects happen in good condition, are executed carefully, because for independent companies, that creates more value than the price itself of your equipment, and they know they are highly reliant on the supply chain, so they're just waiting for people to have them do project and do them faster.